And how do you get the lowest private mortgage lender rate? First of all, it is the overall financial picture that really matters. It starts with you. It starts with your income, your credit payment history. It starts with why you need the private mortgage and how do you exit. So private lenders are very, very, very big on exiting, big on your plan, right? Because it's band-aid financing. You're not supposed to stay there forever. If something smells wrong, if something feels wrong, the lender will give you a higher rate to mitigate their risk. They'll price the deals accordingly. Have a clear vision of, how do you exit? Why do you need the loan? And that's very, very important in getting good rates and getting the best quote. So factor number 2 is loan to value. Loan to value is the amount of mortgage that you're borrowing on this property divided by the fair market value of the property. So that's the loan to value. For example, if you already have a mortgage from, let's call it TD Bank, as a first mortgage, you're looking to take out another $200,000 second mortgage. Let's say your TD mortgage is $400,000 and you're taking out another $200,000 second mortgage. In total, your mortgage borrowing on this property is $600,000. The property is worth $1 million, so now your loan to value is 60%. So that's how it's calculated. That is one of the most important things for the private lenders to determine your pricing and what type of private mortgage lending rates you are getting. So typically, private lenders can only lend up to 80% of the loan to value. And the lower the loan to value, the cheaper your rates will be. And when your loan to value is less than 65, that's usually when you get the best pricing. Some lenders have pretty similar pricing for between that, 65 to 70% and 75 to 75%. But usually when you get above the 75%, that's when it gets incrementally expensive. What are the other things that impacts loan to value is your property value. So you need to make sure that you have a solid, robust grasp on how much your property is worth. And really the best way is to do a appraisal, right? So to do an appraisal report, and obviously a good mortgage broker will help you take a look at it and give you their assessment how much it's going to be worth. We also have another video that we talked about how to get a good appraisal value, what are the things you need to do ahead of your appraisal to make sure you maximize the value you get on that report. So we'll include that in our link as well so that you can check that out. Property itself, the property type and the location, right? There are a couple of factors on location. First of all is urban versus rural. If your property is a little bit rural, there's a 0 in your postal code. Typically that's how lenders look at it. Oftentimes they look at it by how many people are actually living in that municipality as well. If it's an urban property, the pricing would be cheaper. If it's a rural property, typically the loan to value would be lower and the pricing would be more expensive. Property types matter. Residential properties are a little bit more popular and lenders would be jumping on it. If it's zoned agricultural, it's mixed use commercial, it's a lot harder to get private financing. The rentals versus owner occupied, they also have different pricing of house versus townhouse versus condos, and every lender have their own system, and there's, I can tell you, 200 or 300 different private lenders out there across Ontario and across Canada. You really need to know and be specialized in this space to see, where do you go to get the best pricing for your financial situation, your loan to value, and the property type of the property you're looking to finance. There are 3 other factors, what we call secondary consideration for your private mortgage lender rates, and sometimes those may also make or break a deal. One of those factors is the term of the loan. So if you're getting a 6-month term versus a 12-month term, the rate and fees might be different. The 6-month term is usually short term, is for bridge, is for flipping, and the rates can be a little bit better. It depends on the other factors all working together. The 12 months is more of a standard term. Usually most of the private mortgage lender offer the 12-month term. We don't see a lot of 2-year terms. Some of the private mortgage lenders start to offer 2-year terms. Most commonly used term is 1 year. While the mortgage rates might not be that different between a 6-month versus a 12-month term on a private mortgage, really the kicker is the fees. Oftentimes you can get something that's 30% or 50% cheaper on the fees if you're getting a 6-month term. For example, if you're getting a 1-year term private mortgage, the rate might be 8.99 and the lender fee might be 2%. And if you're getting a 6-month term, the rate might be 8.99, but the fee could be 1.5% or even 1.25%. On a 500K mortgage, you're almost saving $4,000. That's pretty significant, right? So if you're just using it for short term and you're pretty sure and you can get that paid out within 6 months, you don't need a 1-year term. The second one, which I talked about a little bit in the beginning of the video, is market conditions. There are period times that lenders are just not lending. That means if the property value is dropping pretty fast or private money are drying up, a lot of lenders would say we're going to pause lending for 2-3 months, and then you have a bunch of lenders pulling out of the market. That's when the rates gets pretty expensive. But still, within that, you can still find pockets of lenders who are open, they keep lending, still want to do business. It really requires someone who's knowledgeable in the industry to help you find the deal, even in a challenging environment. Certain aspects of your credit reports, your payment history. Someone may ask, oh, I thought private mortgage lenders don't really care about credit, right? Why do you ask for credit? That's why I'm coming to private mortgage lending, is they don't have a minimum credit score. That's partially correct. So private lenders don't have minimum credit per se. We've found deals for 400 credit. We've found deals who had thin credit, no credit. But whether you have good credit or bad credit is unlikely to impact whether you got approved or not. But private mortgage lenders use it to price the mortgage. Someone who has a 780 credit score versus someone with a 500 credit score will have a different pricing when they borrow for private mortgage loans. The payment history really matters. They'll specifically look at how you're repaying your previous mortgage. If there was some late payments, if your mortgage is already in arrears, not to say that you won't get approved, but the rates will likely be pretty high.
Learn more about your mortgage options. Visit effortlessmortgage.ca